Stocks higher in early trading in the US market, led by tech names. Our guest says growth has been outperforming value lately, and that's something of a reversal of a trend we've seen over the past few months. We're joined by Michael Zinn, Managing Director and Financial Advisor at UBS. Great to see you, Michael. No trend continues forever. We saw this move out of US stocks, out of growth names, but we're seeing something of a reversal now.
Yeah, good morning, Andrew. Yeah, I think that is the case. I mean, we're seeing an interesting kind of face-off, I think, between the international institutional investor, who I think has been selling out of the U.S., redeploying to Europe, redeploying to European financials and European industrials, and then the retail U.S. investor who's been kind of staying the course. And you know what's been, I think, more evident of late is that at least the AI trade in the U.S. is alive and well. We've been seeing more signs of bottoming of that, and of course the prints from some of the mega players last night are adding some foundation to that, and we'll see how these prints go this evening, because there's probably more risk associated with those names as there's more exposure to kind of the big tariff macro plays. But I think when you look at the U.S. markets and you look at what's happening in the breadth of the rally in the U.S. and where the indexes are, there's a reason to believe that we're building a foundation here. And I think when you look at the overseas markets, which of course have had a great year so far, but the breadth of that rise is actually not super convincing. So I wouldn't be surprised to see a little bit of a turn of the tables where U.S. markets do a little bit better. Having said that, I wouldn't say we're chasing the rallies here, because we're now discounting probably some pretty decent earnings news, some pretty decent trade agreement news, and we all know that we're facing a potential macro data sledgehammer in the next couple of months as tariffs take a toll on inflation and growth and earnings forecasts.
Macro data sledgehammer, I think you got the phrase of the day there. And now, as you say, we are going to get Amazon and Apple reporting after the market. And Amazon, of course, seen as vulnerable here because so much of their stuff comes in from China.
Yeah, there's no question. You know, I'm not talking too particularly about individual names, of course, but I will say, you know, what's super encouraging, you know, was how strong the cloud business has been so far in some of the other prints, and that may be the more important read through. But you're absolutely right. You know, the tariff exposure is going to be a big driver, and what we don't really know is how has the market priced this? You know, has it priced adequately or not? And you know, investors can be forgiven for not being able to really completely grasp the magnitude of these big macro changes. Are we completely abandoning globalization, you know, or is this just part of a negotiating process that evolves into some kind of more balanced trade agreements?
Broadly, how are you suggesting to investors they position their domestic U.S. portfolio? I mean, are you recommending people go for the so-called defensive names, Walmart, Costco? Of course, Walmart does face tariff pressure, but or utilities. Right. Do you think people should be buying the less volatile stocks right now, or should they try to ride this rally in growth?
Yeah, it's a great question. I think the defensive stuff is a little bit played out, and it's a little bit of the time for like the AI trade, the reshoring trade, the industrial trade to take a turn in the U.S. You know, so we would kind of probably have our overweights there, and also have a decent amount of cash as well to deploy on the fixed income side. We're definitely oriented a little bit more towards shorter duration stuff, because I don't think volatility has gone away. And you know, we're in the neighborhood now of the 200-day moving average for the S&P, and I think that's often a big kind of test zone, you know. And if you're very bearish and pessimistic, it's a great time to hedge. If you're bullish, I think you're wanting to wait and see whether we can hang around here and grind our way upward, or whether we fail here. And that's a little bit of a wait and see game right now. And so we're a little bit wait and see too. We were pretty happy buyers, earlier in April. When the VIX hits 50, although it doesn't happen super often, the forward return on the S&P is super, super high. So that was kind of our buy now button kind of indicator. But at these levels, with the VIX more normalized, closer to the 200-day moving average, we're kind of sideline players. We have our positions. We're playing the wait and see game a bit.
My screen is showing that the S&P 200-day moving average is about 5746, 5,746. Right. And right now on the S&P, we're at about 5,622. So we're about 100 points short. So that if it rallies to right up to the 200-day moving average and fails to hold on, would that be a bearish sign?
I think it would be. I think it would be. Now, I think would depend a little bit on the nature of the failure. If it's a hang around kind of thing, our first inclination would probably be to continue to just buy on the dip. But if you really see an abrupt reversal, then I think the downside could be, much more to the lower 5,000 kind of range. So there's enough uncertainty that I don't think we can pretend to know for sure. But I agree with you. Our screens agree. 5746 would be our kind of important level number to watch. And of course, people, because that's such a well-socialized number, may begin to anticipate that. And so you may begin to see the market succeed or fail before then as well.
I know you get into the hole of mirrors, don't you? Everybody trying to work out, will everybody else sell if it doesn't get there? And anyway, infinite regression. Just finally, the Fed. Is it time for the Fed to come out and indicate, we're ready to cut rates? And I think a couple of Fed officials have been doing that over the past week or so.
Yeah, and then I think that's been sufficient. I mean, I think, as long as they signal readiness in the event of weak data, where they prioritize economic growth or protecting against weakness versus tariff inflation, I think that'll be sufficient for the market to feel comfortable with where they are. Conversely, if they come out and place greater emphasis on what could be extraordinarily high inflation data, if we don't get a reprieve from tariffs, I mean, you could see a very substantial move upward on CPI and PCE in the next couple of months. If there's greater emphasis on that and there's a lack of Fed support, then I think that would be a weakening point for the market. And I agree with you that the messaging we've seen, at least from some of the key Fed players, has been that they're willing to look at the economic weakness as a prompt for more of a dovish tilt.
Thank you very much indeed. Michael Zinn has been our guest. Michael is Managing Director and Financial Advisor at UBS.